Thank you very much, and thank you for being here. Jackson National Life did a survey of financial advisors. It's old data, but I think it's still pertinent. They found that 75% of financial advisors will tell you their clients were beating the S&P 500. 75%. Now, if you ask a room of 150 people, how many are better than average drivers? About 75% will say they're better than average. 75% of the financial advisors in that Jackson National Life study in 2012 said their clients were beating the S&P 500. But here's the problem. When Cerulli and Associates, an independent research firm, actually checked, the average client account was up 4% when the market was up 17%. So somebody's lying, and it's probably not on purpose. It's just that nobody actually measures it. I do. I measure it independently, verified, and I've been doing that for over 20 years. In the next 20 minutes, I'm going to show you the actual numbers, not the one that advisors say, the ones that a independent third party tracks every single day. And then I'm going to tell you the strategy behind them. It's not what you think. It's definitely not what Wall Street wants you to do. So stick with me. This is going to save you a lot of money on someone else's advice. I'm Mike Adams, founder of Adams Financial Concepts, and I've been investing client money for over 40 years. The last 20 in my own firm. And the reason I'm telling you this today isn't to brag about a good quarter or a good half. It's because I think most people are getting bad advice about how markets actually work, and it's costing them real money, especially right now when we're facing inflation or stagflation. So here's what we're going to cover. The actual first half 2026 numbers. Why I don't do what most advisors do at all. Why that sounds riskier than it is. And the one number from a Nobel Prize winning economist that explains why almost no one beats the market and why that doesn't have to include you. Here's the numbers. During the first half of 2026, my clients were up 20.5%. The S&P 500 with dividends reinvested was up 19.9%. It's not a lucky quarter. Let me give you the long view because one good stretch means nothing. Anyone can get hot for 6 months or a year or 2 or 3. But since the market bottom in 2009, going on 17 years, the composite has averaged, my client composite of client accounts has averaged 18.2% per year. The S&P 500 over that same stretch, 16. 1 year, we were up 91%. The last year, 91%, against 22 for the index. 3 years, 34% versus 20. 10 years, 19 versus 10. Now, I want to be straight with you because I only tell you I don't want to tell you just the good news, because if that's all I'm saying, you should stop trusting me right now. The 5-year number, when you look at it, actually trails the index, 10% versus 13. I'm not going to hide that. And honestly, that number is exactly why the next 15 minutes matter more than the first 4. Because I'm going to tell you why a stretch like that doesn't scare me and why it shouldn't scare you either, if you understand what's actually driving these results. Because here's the loop I want you to open right now and come back to. How does an independent, no carve-outs, fully verified composite, every account, every client, no cherry picking, end up with numbers like this using a strategy that has almost nothing in common with what your current advisor is doing? That's the real story. Let's get into it. But before I go further, if at any point in this you're thinking, okay, this is actually right for my money, there's no obligation here. You can always reach out and ask me directly. I'll tell you the truth, even if the truth, this isn't for you. The link's in the show notes. No pressure. Just putting it out there before we keep going, because what's coming next is the part that most advisors will never explain to you. Here's the open note from a minute ago. How do we get the number? The answer is insultingly simple. And it's the reason most advisors will never do it. I don't play Wall Street's game. Most of the industry runs on stock screens and technical models and diversification for diversification's sake and algorithms. They spread it across 200 or 300 names, hugging the index, collecting the fee. It feels safe. It almost guarantees you'll never meaningfully beat the market because you basically are the market minus the fees. Here's what I do instead. Every month I read The Economist, a couple books, anything that helps me spot a real shift before Wall Street's algorithms catch up to it. Out of that, I'll look at maybe 40 companies a month. I'll actually check the financials on 8 or 9. I'll read the full 10Ks and 10Qs. The company filings, the real filings, not summaries, not some analyst report, but the summaries of the report that the companies are required to put out. And out of all that work, I'll only make 1 or 2 trades a year. That's it. No screens, no technical charts, no churn. The result is a portfolio concentrated in around 10 stocks. Some of those positions have been held for 10 years, some 20 years, one for 33 years. Although that one, for the last 8 years, I've been trimming back, not completely selling out of it, even though its growth has really slowed down, because for tax reasons, the cost basis is now under 1% where the stock trades today. Everybody's heard, don't put all your eggs in one basket. I can tell you, I don't do the opposite. I put all my eggs in one basket, and then I watch that basket. I can already hear what you're thinking. 10 stocks? That sounds terrifying. I'm not going to dodge it. Let's open it right now. Is this actually reckless, or does it sound reckless? Hang on, because a Nobel Prize winner already answered the question, and the answer might surprise you. Let's deal with it. Yes, concentration means more volatility. I'm not going to pretend otherwise. And here's the distinction almost nobody makes. Volatility is not the same thing as a risk of permanent loss. Volatility only turns into an actual loss when a person panics and sells at the bottom. The way you make money, the only way you make money, is buying low, selling high. That requires staying in the seat through the uncomfortable stretches, not jumping out for the moment things get bumpy. There's a Peter Lynch line I think about constantly. I'm always fully invested. It's a great feeling to be caught with your pants up. Of course he means it's a great feeling to participate when the market is rolling up and everybody thinks it's not. My accounts are always fully invested. That means, yes, there will be periodic losses, setbacks, days that make your stomach drop. A calamitous looking dip doesn't scare me out of the market. I've seen enough cycles to know what happens to people who get scared out. They lock in the loss permanently. And here's the part that I want you to remember, because this is where the 10 stocks is crazy, where that myth falls apart. William Sharpe, Nobel Prize in Economics, did the research on this, along with others. His finding there's no statistical significant difference in volatility risk between a portfolio of 8 or 9 carefully chosen stocks and a portfolio of 300. Read that again. There's no statistical difference in owning 8 or 9 carefully chosen stocks, focused stocks, and a portfolio of 300. Diversifying past 8 or 9 names doesn't meaningfully reduce your risk. It mostly just dilutes your winners. And here's the second Nobel Prize data point, and one that's the gut punch. Eugene Fama, a Nobel Prize winner, found that fewer than 7% of professional money managers even match their benchmark index over time. Fewer still actually beat it. So when someone tells you concentrated investing is reckless and diversifying index hugging is safe, ask them why. Why? If that's true, 93% of professionals holding that safe, diversified portfolio can't even match the index they're trying to match. It's not the concentration is reckless. It's that most people and most advisors don't have the conviction of the process to do it well. That's the actual scarce resource here. Not diversification, discipline. I think this is the most important one because it goes back to the opening start. 75% of advisors say they're beating the market. So why should you believe a single number I've given you in the last 15 minutes? Here's the answer. Fair question. I don't track my own results. I pay someone else to do it. I hired an independent third party to monitor every client account every day and report the results quarterly for every client without exception. It started with a firm called Advent. Advent was expensive, and I moved to Morningstar for about half the cost, and into a platform by people that came out of Morningstar. They formed a company called Advizon, again, and Advizon has more features than Morningstar. But the point isn't the vendor. The point is, I don't get to grade my own homework, and neither does anyone at my firm. Here's what no carve-outs actually mean in practice. I manage 100 accounts. 95 of them are in the composite you see the numbers for. That same composite that I showed on the screen, the graphs. 95 are in that composite. The 5 that aren't are in profit-sharing accounts. They're excluded because they have a different structure. They're long-short. Not because they make the numbers look worse. Every closed account, clients who moved away, clients who passed away, every one of those accounts stays in the composite for the entire period they were at management. For clients who joined this quarter aren't counted yet because they haven't done a full quarter of data. Next quarter, they're in, no exceptions. No quiet removals from accounts that have a bad year. And remember that Cerulli study from the beginning? Remember I said 75%? Jackson National Life, the ones where advisors claimed they were beating the market, and the reality was 4% against 17% index. That same year, 2010 to 2012, the composite was up 17%. Adams Financial Concepts clients were up 27%. That gap, what advisors say and what actually happens, is the entire reason independent verification exists. It's the entire reason I lead with it every single time when I talk about these results. My results are independently verified. Most firms, most advisors don't want to publish the results because they know what it would produce, or they don't know and they don't want to be held accountable. And here's why I think this conversation matters more this year than most. Because healthcare costs are rising 7% and it's accelerating. You've been to the grocery store. If you've been to the grocery store or someone in your family's been to the grocery store, you know the grocery prices. Every day, the prices are increasing. And most people I talk to feel their money buys less than it did even 2 years ago. Purchasing power is quietly eroding underneath a lot of households right now. And it seems like it's only going to get worse with what's happening in the Strait of Hormuz and with what's going on in the market. And next week, I'm going to talk about that. Next week, I'm going to talk about the concentrated companies, the concentration of companies that are controlling beef, chicken, pasta, soy, and all the other things that are going on right now. There's a concentration that's going to keep prices increasing, not decreasing. That's it. Average used to be an acceptable outcome. I don't think it is anymore. If your money is tracking an index that's returning single digits, but your actual cost of living is increasing by 7 or 8 or 9%, or even more, you're losing ground, even if your statement shows a gain. I'm not going to tell you that past performance guarantees anything. It doesn't. Anyone who tells you otherwise is lying to you. But when I look at what this approach has produced across multiple market cycles, including stretches where conventional wisdom said it was mathematically impossible to beat the index, I believe it puts the people I work with in a stronger position for whatever's coming next. So here's what I'll leave you with. If you listen to this so far, you're not someone who's satisfied with the market did fine, so did I. You'd want to actually know whether a strategy like this fits your situation, your timeline, your goals, how you feel about a concentrated portfolio versus a diversified one. There's exactly one way and only one way to find out, and that's not by listening to another episode of a podcast. It's by having an actual conversation with me. Go to the link in the show notes right now before you move on to the next thing and book 15 to 30 minutes with me. I'll walk you through the entire composite going all the way back to 2009. I'll answer every question you have, including the hard ones, about how this actually works. And at the end of the call, you'll know, one way or another, whether it's right for you. No pressure, no script, just numbers and a straight answer. And you'll get an insight. Whether we do business or not, you'll get an insight into what's going on in the market. The link's in the notes. Reach out today. I'm Mike Adams. Thanks for listening, and I'll see you next time. And with all this, here are the notes and disclosures that go with that chart that I produced with the numbers. Thanks for listening. And right now, I'm willing to take questions.